Welcome to another Market Insight Call, where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me as always is Chris. Chris, why don't we just jump right into it? Let's go from a slide that we had last time.
Yeah.
Want to tell us about this slide?
Yeah, I put this together 5 weeks ago or so when we did our last call, just to go through the risk events for March last month. There was a testimony of Powell at one of his biannual events. Payrolls, which always comes up every month. Inflation, CPI, comes up every month as well. For April, we've already moved past payrolls. We got that last week. Nothing surprising. Came in right at expectations. Market didn't really move off of it, did not scare the market. And inflation, which we had this week. What's new and what happened last March, we didn't even have a chance to talk about it, was we did not have failed banks on our layout for
Right.
what was
we can't do
gonna
the
happen.
Market Insight Call without talking about SVB. I know it's dropped out of the headlines so far, but and I'm sure everyone's tired of hearing about it. Thankfully, it did not turn out to be the contagion that so many people fear. But what went on?
Yeah, well, I'll go through it quick. Like you said, getting a little tired of this. And obviously, pause the screen if you want. There's a lot of text there. The left-hand side of the screen is from Silicon Valley Bank. They put together this beautiful marketing piece while the bank was under some trouble, saying, hey, everything's going to be fine if we can raise about $2 billion in cash by issuing stock and preferred securities. And they sold off their asset portfolio, a lot of their asset portfolio, like all of the available for sale securities. And on the right-hand side is from Moody's, which they actually, before March 8th, were in dialogue with them, letting them know, hey, we're likely going to downgrade you. Downgrade's coming. It might be a double-notch downgrade. So SVB wanted to get ahead of it and say, all right, let's shore up our capital ratios. Let's get back in. Maybe we'll only have a single-notch downgrade. And that is what happened on March 8th. Moody's downgraded them, single-notch downgrade. And heading into the next day, things would have probably been okay if they were able to raise some of these funds. But on the next day, on our next slide, you have stock goes down 60%.
Right.
Spooks the market, and $42 billion of depositors asked for their money back.
Right.
That's a lot. There aren't. I don't know about. I don't want to say all banks, but not many banks would be able to handle that large of a percentage of withdrawals because they're not sitting on that much cash.
Right. It's one of the things that you think about is banking. It's a Wonderful Life. I'm sure a lot of listeners are familiar with that movie. Is banks are always unable to meet all of their demand deposits at any given time, and there's textbook processes to try to slow what essentially would be a bank run. And historically, you just take your time with depositors. There's a queue that everyone has to line up with, and you can just go slow on giving that cash. But now, in the digital world that we live in, $42 billion couldn't be processed by individual depositors just showing up at the bank. But it certainly can be whenever it's just a click of the mouse and transferring out. So that is definitely a new paradigm that we're having to deal with at the moment with the Fed, as well as the Treasury Secretary are also commenting, not all of their comments helped the situation. But I also kind of laugh on how SVB came out and said, hey, as long as you give us money, we're going to be doing great. My balance sheet's going to be incredible if you guys just send me money and deposit it on my balance sheet as well. So I just think this is a new era that we're having to deal with the ability to basically do bank runs pretty quickly. That's probably going to have to be dealt with by the central bank.
Yeah, and we talk about the yield curve a lot, and what I was just saying about yield curve is banks, they borrow short and they lend long. Right. And so we talk about that all the time, but we don't really point out that's the mismatch, duration mismatch, and like you said, that is banking.
Right.
Silicon Valley was unique in the sense that they had massive deposit base that can quickly pull their funds. And they had assets that were default risk-free. They were in mortgage-backed securities backed by agencies of the government and treasuries, but they had declined significantly in value. And they had to sell some of those to meet these withdrawals. Like you said, the Fed has come out with new lending facilities where they're saying, all right, we'll take those bonds at par, even though they're probably priced below par, and we'll give you lend up to par value for them so you can have some more liquidity.
Right, and it's not a coincidence, one, that we have an inverted yield curve, that this is happening, and that interest rates are going up, because just as much as you have your demand deposits that are loaned out, we'll use the mortgage example because I think that's where it's more familiar. You loan that out, and that's what funds those deposits, right? That's how you earn interest on your deposits. But if everyone pulls them out and you can't sell the mortgages quick enough to be able to get enough cash to meet the deposits, you have issues, especially if the interest rate has gone up, because you discount those bonds, and it'll be returned eventually whenever the bond matures, but also on the increased yield that you're getting from that value of the bond. And once again, this is just banking, and it's going to show up. Especially, it's first going to show up in the banks that are more risky, which SVB was. But this is just normal banking, and why the historical ways of dealing with bank runs, we're probably going to have to figure out different ways of dealing with this in the new digital world.
Yeah. And so you had the bank run on Thursday, and then Friday, FDIC took receivership already. And so we could look at a couple positive things of what happened to the market. When you look here at this slide, it's simply saying the market didn't really care.
Right.
S&P 500 since March 8th, when this started, is up about 3%. So they said, what failed banks? And technology was up more than that, about 6.5%. But financials are obviously going to be down as they're most exposed, down about 8%. So if you're trying to say, well, what's the good news? The market wasn't super concerned here.
And I think one of the reasons they're not concerned is because they know the Fed is going to have to act. And we're going to talk about this a little bit on how technology stocks relate to interest rates, and how, at least as of the last decade or so, have been kind of that flight to safety, because the way that interest rates affect the value of more growth stocks. Which, to me, when I look at this, what I'm trying to understand is, what is the market thinking? What is the market pricing in? And I think what the market is telling me is that the idea that we continue to raise rates is no longer the consensus case. There is a beginning to price in the Fed's going to be accommodative. The Fed's going to meet this. They're going to have to expand the balance sheet to get past this, and that's why we see technology and the S&P move up. And it's the banks, other than their specific risks, that's the reason they're selling off.
Yeah, so let's look at that in terms of probability. So right now the Fed has short-term rates at 4.75 to 5 as their range. When we look at what is a market rate on the futures curve of what they're expecting rates to be at the end of the year, the largest probability at 38% is at 4.25 to 4.5. So they're saying, no, there's going to be a couple cuts here, and actually the market is expecting 75% chance at the May meeting that there's going to be one more increase, which means the market's really expecting about 3 rate cuts heading into the end of the year.
Right.
And we can see how that evolved on the next slide, as that's what it was. Now we can look a month ago, which is the far right-hand side of this on March 10th, and you can see at that time, they were expecting rates to end the year at about 5.25. So over the last month, we've shifted towards the left-hand side of this, where the market is now saying, over the last month, rates are coming down. Like you already said.
And we see that in the probabilities. We've even talked about it internally. We have an ongoing bet on where we think interest rates are going to go. And we think that, yes, there will still be one more rate hike. But as the possibility of a recession, I know that's the R word, comes in, I think we start to think about lower rates. And the market, at least some of the market, is beginning to price that in. As you point out here on that slide, you can see the difference in change from 1 month ago to where they are now. It's kind of moved down to where that probability is, because the market is starting to say interest rates can't stay this high or this long.
That's market derived. When we look at the Fed's last meeting, it was a projection meeting. So they're going to tell us what they're saying they see. And the far left is their expectation of where the dots are, where the rates they think are going to be. Each one votes. And you can see there's an outlier. There's one that says, hey, we're done. 4.75 to 5, we're already there, we're good. Most participants say one more increase. We're at 5 to 5.25. So we've been saying it for a long time, probably about a year. We just have to get past these rate increases. We have to move past it. We're almost there.
Right.
One more.
Now, these assumptions are always just like this economy that has this slow cycle, and what happens is the Fed will all of a sudden move interest rates down quickly. They're either becoming accommodative or they're tightening, and these moves are pretty sharp. And we felt that sharp move to the upside. We've been talking about that for quite some time. So I don't think it'll be gradual, as this dot plot shows. It'll be a little bit more immediate, but it seems that they think the natural rate would be around 3% long term.
Yeah.
So that's probably a good idea to think about as where these rates go whenever the Fed starts to act to the possible recession.
They don't just go, hey, we want one too many, we'll pull one back.
Right.
Well, they have done that before. They did that, I think, in 2016. But
they tend to overshoot,
unlikely,
right?
yes.
They stay accommodative too long, or they stay hawkish too long, and they don't let that lag really.
And the other point that shows that, that they're kind of just, I don't know, throwing darts is at the last press conference, Powell goes, yeah, the tightening that we're seeing from these bank failures, that's about a rate increase. Yeah, that's one. Like, how does he come up with that being equivalent to one? But that also helped bring down their expectations because they're seeing tightening in credit from bank failures. That makes sense, and they're responding to it by reducing their expectations for rate increases.
So I think I've said recession twice. Why don't we talk about how this affects the market and how the market is seeing it? And I think this is a great slide that you put together from LPL. You want to talk a little bit about this?
It's great. They actually call it a Fed pivot, and if you follow what we say, when we say pivot, we usually mean Fed starts cutting rates. And while they said Fed pivot, they mean stopped raising rates. So if we take the Fed at their word that they're done soon, this chart takes a look at past rate cycles since the 70s and says, all right, once the Fed had stopped raising rates, what was the impact on the market? And when you look out 12 months, so that's the far right side again, returns were over 12% on average, 12 to 17% depending on the index. And of course, there are down periods where you end up falling deep into recession and you go down before you come back. But on average, returns have been over 12%.
Right. So we may be moving into a recession. I think that's likely that we'll have a recession. That doesn't mean that the market is going to tank here. Actually, a lot of times these things are forward-looking, and it's when we're in the recession and the Fed starts to become accommodative that we finally have bottomed and start to move up on the market. And specifically, if you look at here, it's the growth side that really wins. And a lot of that is for the same reason that interest rates affect the valuations, and when you're raising them, growth stocks get hit harder, and that's why we had been in value for a while. When you come out of that and interest rates start to move down, then growth stocks benefit from that as the valuations increase. But those valuations are based off earnings, and we're coming up into earnings season. Why don't we talk about the fundamentals of a company?
Entering earnings this week, really, from Fridays when a lot of the big banks start reporting. What we pulled here on the far right is Yardeni. He tracks earnings and consensus, a bunch of different estimates from Refinitiv's tracking. And when we look at towards the bottom, 2023, you can see Yardeni saying for the whole year, we're going to have about $225 in earnings on the S&P 500. Well, the consensus is more like 219.83. But if we look right below that, we can see the actual quarter breakdown. So what is the market expecting from the analyst consensus on Q1? 7.7% decrease in earnings. And next quarter, 6.6% decrease in earnings. So the market is starting to has pretty low expectations for what's coming. The difficult part here is that there are higher expectations into the end of the year and built in through 2024. So I think you get a couple throwaway quarters where earnings are going to be poor, but the market is going to have to, or companies are going to have to start recovering those earnings into Q3, Q4 to support current pricing on the S&P 500.
Right, and I think that's important to just emphasize. It's all going to be about those last quarter earnings within the year because one, all of those lower earnings that are already currently projected are no longer there. So it would be basing off of that and increasing. And then because we would see increasing earnings, we would have PE ratios, those justified PE ratios, go back to some of those 5-year, 10-year averages. So it really is all about the earnings in the second half of the year. So even if we were to have a recession here, where we see a dip in earnings, if it looks like those Q4 earnings are correct and we're moving up from there, all of a sudden that market's going to rally out of that despite being in a recession. So that's why you don't want to just be out of the market here near what's hopefully close to the bottom of a market correction as we start to recover and the market starts to price in that optimistic take on those earnings.
So before moving on to some of the negatives that are going on, right, we've been sticking with the positives here. The bottom left of that chart, we took and we said, all right, most simplified way of pricing the S&P. We said, all right, at the end of the year, you apply 5-year, 10-year, 15-year average PE multiples to the expectations that Yardeni's given us, so the higher one, 250, and you say, well, what would that price the S&P 500 out at? Somewhere between 4,200 and 4,600. So if those earnings recover, you can start to see a justifiable PE ratio where you can have a recovery in the market to 4,200 to 4,600.
Right. So once again, all about the last quarter earnings is what the market is really going to be focused on. So one of the changes that we've made to
a couple
strategies.
strategy changes a few weeks ago, as this all started happening. Right.
And this is more in non-taxable accounts, right? The more tactical allocations.
We had some small cap exposure, larger than really what the global economy, global benchmark would be. We removed those. And in very tactical strategies and qualified accounts, we completely removed small cap. By doing that, just taking out the small cap index, it is a little bit heavier financials, slightly, than large cap, and it has less technology. So we can move up in market cap and increase technology. As we said, that's what's performing well, just by making a market cap size change from small cap to large cap. And that's primarily what we did. Right? In the medium term, long term, these smaller companies, especially the financials, they're going to have higher costs of capital. They're certainly going to have more regulation, and we're already seeing that there's tighter credit and lending standards that's coming out of this. Something we don't think is going to be fixed in the short term.
And one of the things that with these financials, a lot of them are regional banks. And one of the issues with this deposit is Secretary Yellen, when she was at Congress, had mentioned, well, they would step in if it's a systemically risky bank, meaning a big bank, not a small bank. And what that did was it caused a lot of people to say, well, let's just move our deposits. It's just a click from local regional bank to large behemoth bank so that I know that it's there. So there was a little bit of a bank run on banks that are fine, and that's definitely going to impede their ability to raise capital if they're having to compete against larger banks that basically have the backing of the Fed. So once again, these are areas of regulatory concern that the government and specifically the Fed is going to have to address with these situations.
We will hear from the C-suite from J.P. Morgan later this week, but I know we were talking to our contacts over there, and they were saying, yeah, they're thrilled to be. They've been working nonstop to help get a lot of this money from these smaller banks, but they know there's more regulation coming their way, and they're going to have a bunch of bills to foot there as well.
And to your point, it's none of these problems are going to get fixed over the next couple of quarters. But the changes that we've made, to reiterate, is we've moved some small cap exposure, which is heavy finance, up to large cap exposure, which is technology. So not only have we kind of gone to something that's a little bit more stable if we are moving into that recession, but also we've reduced our financial exposure and increased our technology exposure. And as we saw in that previous slide, if things work out the way they historically have, and the way we value stocks continues to stay the same, you would think technology is going to have a nice run based on those factors.
And in the short run, when we did sell some of the small cap, it had brought down the whole market with it in the short run, right? So it's not like you sold something and bought something that was up significantly, because in the short run they were all down together.
Right. And that's one of the reasons that it's important to understand what index you're in, because if you had an underweight to technology and kept that underweight, you're looking at your portfolio and you're not keeping up. But what you may not understand is you may be taking on excessive risk if you're too far overweight in technology. And this is something that's not unique to this year. It's been going on for well over a decade, where there just seems to be a few names that are really causing the S&P 500 to move up, and they continue to take and become greater and greater share or market share, or a larger percentage of the S&P 500. So it's something you certainly want to be aware of. But at the moment, these are some of the areas that you do want to have exposure to, because they're benefiting, and it's basically, it's not that they're in technology sector, it's the way that you actually value their future earnings, and they all are more growth stocks, so that they're getting valued in a similar fashion based on interest rates. So sticking with that yield curve, we've had a negative yield curve. If you're familiar with looking at these types of slides, you would notice that those gray areas are recessions. The yield curve goes negative, goes below that line, and that typically is a strong indicator. It's got 100% certainty historically of a recession. It just takes time, and we definitely are very negative on the yield curve, and we don't think this is going to be different. We do think that there's going to be a recession. but that doesn't mean that the market hasn't priced all that in. And we're starting to see that recover as well. We're starting to see the yield curve lessen, which you talked about banking. This is basically the banking indicator, right? They are able to take or borrow short, meaning they have to pay interest rates to depositors, and lend out long. And when that's negative, it's just not good for the banking. Well, once that goes back the other way, then banking's going to have some tailwinds to help them through.
The way it usually goes back the other way is the Fed starts cutting rates.
Right.
Because they've increased the short end of the curve. The market's saying, hey, you're probably going to cause a recession, which brings down rates on the longer end down, further down. And we've talked about how the market's saying, they're going to have a couple rate cuts later this year. Again, similar slide. This is Fed funds rate. And you can see there are times where there are a couple cuts where it happens. But primarily, you're getting cuts in those shaded areas where the Fed's cutting rates, and they're cutting rates because there's a recession.
But that if we were to lay over the S&P 500, you would see that the S&P 500 is increasing most times in that gray area. So it's not, we're going into recession, now sell. You should have sold before, which no one ever can time well. So it's best to just try to deal with the risk and know where you are in the environment. And we think we're further along in this market correction. Not saying that we can't put in a bottom here, but when the Fed does act, that's whenever the market is going to finally rally and we'll begin another bull market. It's been a long wait, and that usually means that the recovery is much longer as well. You want to talk about the leading economic indicator?
Yeah, and what we've talked about a lot is already in this indicator, right? I think there's about 11 different indicators that go into this, from the yield curve, from credit, employment. It has a very good predictor of when recession's coming. And we're relatively deep into the signal where, again, it has had 100% as well as predicting future recession. And we're still, I mean, if you squint, you can see it moving back up, but it is still below its recession signal. So we aren't getting great leading indicators showing us to say, hey, to move us off of our base case, which is recession.
Right. But once again, we believe that's already priced in. So this is when investing gets difficult, and it's taken a long time to get where we are. You constantly are not feeling that increase in your portfolio, even though year to date most portfolios are up. We're still not back to that high, and it gets really difficult in here. But this is actually when you start to set up for the inevitable recovery here. So stay invested through this market, even if we do have a correction. Actually, if we start to have a correction, we'll begin to become more aggressive, especially if the Fed starts to become accommodative when seeing those interest rates going down. So this is not the time to get out of the market at all. You want to talk a little bit about this contagion?
Yeah, right now it doesn't look like there's much contagion, and contagion can measure it in a bunch of different ways. This was from an organization that measures it with size, leverage, and connectivity across the banks. So the largest bank, as you've mentioned, systemically important banks, JP Morgan, it's ranked the highest, meaning if JP Morgan goes under, the whole financial system is in trouble. Now Silicon Valley Bank, as we've kind of mentioned, we weren't very aware of this bank. It's smaller, but it is still ranked, medium on this list. It's about in the upper third. It has a 24 next to it. It's still pretty good sized bank. So that's always a risk event, that this is not just an outlier and that there could be more.
And we get a lot of calls. People are saying this feels like 2008, and it certainly does. At least whenever SVB and the other banks were having trouble. The difference between now and 2008 is that we've already been through 2008. And that means that the Fed is going to be far more active and quicker to respond to the situation, because they're very much more aware than they were in 2008 of this type of contagion. And that's why they've been acting so quickly. So though it looks like 2008, and I think you can make a case that this can run away, it's because of that the Fed would act quickly. So that's why there's a slight difference now versus 2008. And then if we look at money supply, this is something that we continue to watch. It's ticked up. It's actually really difficult to watch right now with the amount of Fed activity going into the repo market, repurchasing these bonds at par value or face value from the banks. This is ultimately what is driving the inverted yield curve as the Fed rolls their securities off their own sheet and raise interest rates, is ultimately creating that higher rate. So why you can get 5% on one-year treasuries is because of what the Fed is doing. To unwind this, they're going to increase the money supply, and that's a signal that we're looking for. And once we start to see that signal, we'll be far more comfortable about adding risk back into the portfolio beyond just some maneuvering here based on some technical signals. So that's what we're looking at. It's certainly been a difficult market. I don't want to say that it's not been a difficult market, but there are still a few things that we can pay attention to that will at least tell us whenever the worst has really passed. Another thing that we're seeing, so we didn't have SVB on our radar prior to the situation. We're looking ahead and saying, well, what are some other headline risks? What are the other things that could drive the market and really pay attention? And one thing that we do see is the U.S. currency or the U.S. dollar is going to lose its global reserve status. And we've certainly used the dollar politically, which is it definitely detracts from its security in people's minds that are outside the U.S. that are using that. But we think this is much to do about nothing, at least right now, because for a replacement of the U.S. dollar as a global reserve, you got to have a good alternative. And there just isn't as good of an alternative as the dollar, despite our using it in a political nature. It needs to be used frequently in international trade. The dollar certainly meets that, as does the euro, and some the yuan. It has a high degree of convertibility. We could say similar things about those currencies, not so much about the yuan, and that's the one that everyone is talking because of the BRICS nation using it. They have a lot of capital controls. It's just not as convertible as the US dollar or the euro. The domestic economy is large with open financial markets. All three of those are certainly large. The question is open financial markets. Not so much in China, and the domestic economy is large. Sure, they all have that. And then domestic macroeconomic policies are stable and allow economic openness. We definitely have constrained some of our openness, say that 20, 30 years ago compared to the US, but it's still far more open than a country that uses capital controls and really couldn't undo that without having some significant impact of their overall economy. So no, we don't think the US dollar is going to lose its global reserve status. That doesn't mean to say that it can't be impacted. We've certainly seen that that the unquestionable seat that the U.S. dollar has as the global currency has been questioned, right? So it can't be unquestionable anymore. And we've seen this. You want to take this slide a little bit?
Yeah, it's just simply showing that the U.S. dollars in the blue side on the right there, it's about 58% of global reserves. Well, in 2014, that was 66%. So we are moving down, right? Like you said, it's not massive, it's not significant, it's not below 30%, say, but it is certainly coming down.
Right, and to me, if I need to put reserves somewhere, and my choice is yuan or the dollars, I think most people still want to put it in the dollars. It's just why would you take the other political risk? And another comparison is the interest rates.
Right.
The Federal Reserve, we have higher interest rates than pretty much all of these other options, and everyone is in just as much economic malaise as the U.S. government, actually probably more so, and their interest rates are lower. Why would you make these changes? Mm-hmm. I just don't see those headlines really accurately capturing the current situation. Has the U.S. government probably abused some of their power by being the reserve currency? Absolutely. But there's really no good alternative. It still is the best alternative. So any other comments that we want to go over? Well, we really appreciate you tuning in. Dan, we still haven't gotten the lights fixed. I'm sorry that everyone, we have to keep doing that, but go ahead and hit that like, and if you haven't subscribed yet, hit that subscribe button. And please feel free to share this, especially if there are other people that are asking about some concerns, whether it's SVB or the global currency situation. Hopefully this is an informative video and can help bring light there. We thank you, and we'll see you next month.